Imagine you worked hard for an entire month, received your salary, and carefully saved a portion of it. You did not spend it frivolously, you did not waste it, and you did not make any bad decisions with it. You simply kept it, stored safely in your bank account or tucked away at home, and you felt good about that decision because your money was right there, untouched and secure. Now imagine doing that same thing for 10 years. Saving consistently, spending carefully, and keeping your money safe. At the end of those 10 years, you open your account expecting to feel proud of what you have built, and the numbers are there exactly as you left them. But something has quietly happened that nobody warned you about. The money is still there, but its power is not. What $100 could buy you 10 years ago now costs $137, according to inflation data published by the U.S. Bureau of Labor Statistics. Your money did not move, but the world moved without it. And that gap between what your money is worth on paper and what it can actually buy in real life is called inflation. And it is the single most silent wealth destroyer that most ordinary people never see coming. This is the starting point for understanding why investing in the stock market matters. Not as a get-rich-quick scheme, not as a gamble, but as a necessary and deliberate response to a financial reality that affects every single person who earns money regardless of how much or how little they earn. Inflation does not discriminate. It erodes the value of savings held by billionaires and the value of savings held by everyday workers in exactly the same way. Percentage by percentage, year by year, silently and consistently. So what does the stock market offer as a response to this reality? At its core, investing in stocks means putting your money to work inside real businesses that are actively growing, generating revenue, hiring workers, and creating products and services that people pay for every single day. When those businesses grow in value, your investment grows with them. And historically, according to data from the Federal Reserve and research compiled by Morningstar, the U.S. stock market has returned an average of approximately 10% annually over the last century. Compare that to the average savings account interest rate of around 0.4% documented by the FDIC, and the difference becomes impossible to ignore. $1,000 in a savings account for 30 years at that rate grows to roughly $1,128. That same $1,000 invested in a broad diversified stock market index for 30 years at the historical average grows to approximately $17,400. Same starting amount, same 30 years, completely different outcomes, and the only difference is the decision of where you put the money. Now, it is important to be honest here because the stock market is not without risk. Prices go up and prices go down. There will be years where the market loses value, and those periods can feel deeply uncomfortable. But as the World Bank and decades of independent economic research have consistently shown, the long-term direction of a broadly diversified market portfolio has historically trended upward because it is tied to the growth of human productivity, innovation, and the relentless expansion of global business activity. The risk of investing thoughtfully over a long period of time has historically been far smaller than the risk of never investing at all. The real question that this video is asking you to sit with is a simple one. If your money is sitting still right now in a savings account, under a mattress, or anywhere that is not growing, what is it actually doing for your future? Because according to everything that credible financial research has documented over the last 100 years, money that does not grow loses ground. And the stock market, understood properly and approached patiently, is one of the most historically proven tools available to ordinary people who want their money to work as hard as they do. You do not need to be wealthy to start. You do not need a finance degree. You need knowledge, patience, and the willingness to begin, because the most expensive investment decision in history has consistently been the decision to wait.